Partner buyouts are a common part of business. There are many reasons partner buyouts occur. And one of the more common ones I see is when an investor type helps an entrepreneur get off the ground with an equity infusion. And after so many years go by, that entrepreneur has a successful, cash flow positive business, and the investor's got a return on their money, and they're willing to exit for a lump sum payment. And the entrepreneur realizes they're giving away half their profits, so they agree to a partner buyout. Another common reason is when two owner-operators get into business together and one reaches retirement age sooner than the other, but the younger one isn't quite ready to sell the business. A partner buyout works great in these situations, and an SBA 7A loan is how you get it done. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to explain how SBA partner buyout deals work. And there's one very critical guideline with SBA that surrounds partner buyouts, and it can mean the difference between 90 or 100% financing. And it gets a little complicated, but if you stick around to the end, I promise I will break it down. Now, just to show you how obsessed I am with SBA, I had this custom hoodie made with former SBA administrator Linda McMahon, arguably the best SBA administrator of all time. And now let's get into the episode, now that I've embarrassed myself. In order for a partner buyout transaction to be eligible for SBA financing, this is very important. The buyers of the shares must end up with 100% ownership, which means the sellers must end up with 0. For example, you own a business 50-50 with a partner. One partner can buy out the other partner completely and end up with 100% ownership. That's eligible. What you cannot do is use an SBA loan to buy out part of a partner's shares. You gotta buy the whole enchilada. Now let's say there are 3 partners and one wants to exit. Partner A and partner B can buy out partner C. It doesn't really matter how many partners there are. You can have 15 investors and you can buy them all out. Again, as long as the buying partners end up with 100% ownership and the selling partners go down to 0. Additionally, the selling partners must fully exit the business after closing. Only exception for that is they can stay on for a period of up to 12 months as a consultant to help with any sort of transition that needs to occur. All right, now let's get into the terms. SBA loans for partner buyouts offer a 10-year term, and if there's real estate involved, possibly longer. But assuming a 10-year term, you'll be pleased to know that there is no prepayment penalty. You can pay it off as fast as you'd like. And the maximum interest rate is prime plus 2.75% adjusted quarterly. So just to give you an idea, on a $1 million loan at 6.5%, amortized over 10 years, you're gonna have a monthly payment of just over $11,000. One more thing, be prepared to pledge all available collateral, which basically means any real estate that you own with 25% or more equity. For more info on the SBA's collateral requirements, check out this video. I'll provide a link in the description below. All right, now let's talk valuation, because unlike a business acquisition, the market forces aren't always at play on a partner buyout. Often the partners agree to a price seemingly at random. They might have agreed to it a number of years ago, who knows? But I'm here to tell you that a third-party business valuation must be used to support the SBA partner buyout loan, meaning the portion of the loan being used to facilitate the partner buyout can't exceed the business valuation. So if the lender's financing 100%, then it's gonna have to appraise at the purchase price or higher. And if they're only able to finance 90%, then you'll have 10% wiggle room on that appraisal. Beyond that, if the appraisal comes in low, you need to either A, lower the purchase price, B, inject more cash, or C, your partner can finance part of the transaction, or D, a combination of all 3. Now, in the beginning of the episode, I promised that I would explain the guideline that the SBA put into place for lenders to use to determine when a 10% equity injection is needed on a partner buyout. It's simple. The business balance sheet for the most recent completed fiscal year and current quarter must reflect a debt to worth ratio of no greater than 9-to-1 prior to the change of ownership. Duh! Let me simplify that for you. Basically, if the business already has 10% equity, then the buyer doesn't need to inject additional equity. And to determine this, we're going to look at the equity on the balance sheet. There is one caveat though. The buyer or buyers must have actively been participating in the business operation, holding the same or an increasing ownership percentage in that business for at least the last 24 months. So you have to be working in the business and your ownership has to have been the same or have been growing. It cannot have been decreasing. The most common example where I see this become an issue is where the operator sells a chunk of their business to a private equity group or an investor, and they soon come to realize that they made a mistake. And they scramble and apply for an SBA loan to get them the hell out of there. Well, in that case, their ownership percentage decreased in the last 24 months, and so a 10% equity injection will be needed in that scenario. And if you do have to inject 10% into your partner buyout transaction, it's very important to understand that the SBA has very specific requirements as to the source of that injection. And it's got to be cash. Cold, hard cash. That's your only option here. Wait, what about? Nope. But wait, what if? Cash. That's pretty much it. If you have any burning questions about SBA 7A loans for partner buyouts, drop them in the comments and I will do my best to answer them for you. So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, I would invite you to click that subscribe button because I've got plenty more where that came from.